Everyone wants to know when interest rates will fall after 18 months of increasing. Where interest rates will level the playing field is shown. Interest rates might be confused with automobile, mortgage, and credit card rates. Feed video rate. The federal funds rate is set by the Federal Reserve Bank, which is a central bank in the United States. And the federal funds rate is the interest rate at which banks lend money to each other. So you can kind of think of it like the wholesale price that banks have to pay to borrow money. However, when you go to the bank to borrow money, you're paying the retail price. So if banks have to pay a higher wholesale price, they're going to have to charge you a higher retail price. So when the Federal Reserve Bank raises interest rates, that puts upward pressure on consumer rates. Things like mortgage rates, things like car loan rates, things like your credit card interest rates, because now they have to pay more money to borrow money from each other. This is a chart from the Federal Reserve Bank showing the federal funds rate from the year 2000 until now. And what you'll see is in the early part of this century, between 2000 and 2002, interest rates, the federal funds rate rose up to about 65. But then we had the 2021 dot-com crash, which brought the recession. The Federal Reserve Bank cut interest rates very low, and then they started rising again before the 2008 crash, going all the way up to about 5W. But because of the recession, the Federal Reserve Bank cut interest rates again to stimulate the economy, and ever since about 2009, you saw interest rates stay very low near zero until about 2016. This is where you start to see interest rates start to rise again, and they rose all the way until 2019, because in 2019, the Federal Reserve Bank was worried about a recession. This is before the pandemic started. The Fed started cutting interest rates again and again and again, and then came 2020, just the pandemic hit. And the Feds cut interest rates all the way down to zero. Then we saw interest rates near zero until 2022. And then between 2022 and now, the Feds have been increasing interest rates at near record speeds, even faster than we saw happen before the 2008 crash. See, the Federal Reserve Bank uses interest rates almost like a temperature control on the economy. If the economy is getting overheated, if inflation is getting too hot, that's when they raise interest rates to cool down the economy, because when you raise interest rates, you cool down spending. Fewer people are likely to buy a home. Fewer people are likely to buy a car, and fewer people are likely to go out and shop, which helps cool down the economy. If you see an economic cool down, if you see a recession, that's when the Federal Reserve Bank generally will cut interest rates as a way to heat up the economy, like we saw happen in 2020, 2008, and 2001. When we saw those recessions, the Federal Reserve Bank cut interest rates because when you cut interest rates, it makes buying a home a little bit cheaper and a little bit more affordable. It makes buying a car a little bit more affordable. If you're getting debt, it makes your credit card payments a little bit more affordable, so people are more likely to spend. So the Federal Reserve Bank uses interest rates as a temperature gauge on the economy. And today, the reason why they've been so aggressive in raising interest rates is because of inflation. This is a chart outlining the inflation levels in the United States. The red line shows core inflation, which is the Federal Reserve Bank's preferred measure of inflation. And the blue line is what's called headline inflation. And what you'll see is that after 2021, we saw inflation really skyrocket. Ever since the middle to the second half of 2022, we have been seeing inflation fall. However, it's not been a steady line downward. In fact, core inflation, this red line, still has quite a bit of a way to go to get to where we were before the pandemic. Now remember, the Federal Reserve Bank has been working to raise interest rates as a way to cool down inflation. How cool do they want inflation to be? Well, according to the Federal Reserve Bank, they want inflation to be at 2i, and when they say inflation, they're talking about core inflation, which means the Federal Reserve Bank is working to bring core inflation down to 2i. If core inflation does not come down or is not on its way down, they could be enticed to keep interest rates high and maybe even raise interest rates even further. If you scroll down in this article, you will see a quote from one of the Federal Reserve Bank officials, who said, quote, "At this point, I think we should increase federal funds rates again in 2023 and hold them there while we gather additional economic data and assess financial tightening. High inflation may raise interest rates. Despite signs of an economic downturn, inflation persists, so you should understand what this implies. Because they don't want to provoke a recession, the Fed has been slow to raise interest rates. Check it. This graphic compares 2020 pre-pandemic stock values to now. Recently, stocks rose 30A generic inflation calculator. Prices jumped 18I while stocks and houses rose more. Check it. The graph shows a 177 American income growth since 2020. Thus, incomes have grown but not quickly enough to match growing housing, asset, and lifestyle prices. Since you know how rates got here, why would the Fed decrease them? Today, they want 2 inflation. An outbreak decreased prices and generated 1.4 inflation in 2020. 2021 inflation started to hit 7 headline inflation in 2021, 2022 65 headline inflation. In 2023, it is expected the headline inflation will be around 4.1. Now the question is, what will it be in 2024? Will it fall down to 2024? Or will it take more time? Because remember, the Federal Reserve Bank wants to not only see inflation fall, but stay at around 2.0 before they consider cutting. We hear the Federal Reserve Bank officials say they might expect more interest rate hikes. If inflation does not come down fast enough, what we're seeing is that it's more challenging than expected, or at least that the Federal Reserve Bank expected to bring inflation down. We've been talking about this for a long time, and this is where we now understand that if inflation is going to be more challenging than expected to come down, interest rates could stay higher for longer. In fact, they could even go higher from here. In fact, they might need to go higher from here if inflation doesn't start falling even faster. But there's one little X factor here that I kind of hinted at a little bit earlier. And the X factor is what could be happening in the economy because higher interest rates cool down the economy. Now in the previous recessions that we have seen in the 2020 pandemic, the 2008 crash, and the 2000 recession, what we saw was that the economy went into a slowdown. The Federal Reserve Bank cut interest rates, which then stimulated the economy. In other words, the Federal Reserve Bank essentially created inflation as a way to cool the economy because when you cut interest rates is a way to kind of inflate the economy. But in none of those previous recessions were we facing an inflation problem. Before the recession, you can see why that might be an issue because if we start to see more of an economic slowdown in the next 12 to 24 months, the inflation is still high now, and the Federal Reserve Bank will have to make a very tough decision. Do you continue to fight inflation or do you fight the slowing economy? Because you can't do both simultaneously because if the federal bank pivots and they starts cutting interest rates to fight the slowing economy, then everybody starts buying a home again, and everybody starts buying a car again, which could push inflation back up. That can make the economic problem better, but that makes the inflation problem worse. You cannot fix an inflation-induced recession by creating more inflation. That's the tight wire now that the Federal Reserve Bank is walking, so they want to raise interest rates but not too aggressively. This will induce a significant recession. However, we've already increased interest rates many times, which could already tip the United States into a recession. Now the question is, what's going to come next? And this is why I've been saying for a long time that 2023 is not the year for you to go out and finance a new car if you like the new vehicles. Compare costs. Do not fund one this year. Instant learn about money and conditions. Save for odds. Study economics and invest intelligently. Financial instruction is in our media summarized ebook. US News selected the top 7 dividend-paying ETFs. Study before investing and avoid random YouTubers. Moneycraft Masters out.